We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. We're excited to be in the podcast studio this morning. I'm Gabe Johansson, here this morning with Trevor Howard, Mike Nuss, and Dane McKinney. This is the favorite part of our week. We love recording this podcast. I think it's like one of the favorite things I do. So if you're listening to this, I don't think we have very many listeners yet, but if you are listening, we appreciate you. Thank you for listening. Please tell your friends about us. We're really having a lot of fun doing this. So today, we've got a very special episode for you. We're going to talk a little bit about a market update, where the market's going, and we're going to talk about Mike's transition. Mike is going through a change, and we're going to dive into that a little bit, hopefully. So, you want to tell us where the market's at? Like, so Fed met this week. Dane?
I don't want to tell you. I'm just excited to be back.
Oh, Dane.
Yeah.
Here's Dane.
He's
back.
I haven't gotten to talk for like
back
2 months.
We need more,
honey.
Dane.
They need to let you talk more.
That is exactly what my mom sounds like.
Yep.
Yeah.
Your mom listen to this podcast?
She loves listening to the podcast.
But she wants to hear you talk more.
Yeah.
Okay.
I think she...
Can you kick us off with the economic start then?
With the update?
Yeah.
Well, yeah. Kinda.
Put you on the spot. He wasn't ready. This is what it feels like to get put on the
Here's
spot.
the thing, because I don't have the same level of
Ego, conviction.
I was going to say
excitement,
ego.
passion.
I was trying to find another word for ego.
Are
but that
you
was the
sure
one.
you don't?
Well, I
Confidence?
try not to show it, which I think it means that I think that means it's slower. Anyways, but what we thought was going to happen, and by we, I mean me, with interest rates is exactly what's happening. So that's what everybody said, hey,
what's
interest
happening?
rates.
Wait.
I've been asleep for a few days. What's happening?
Did he just throw out an "I told you so"?
Oh,
I did not, because I didn't tell anybody other than like a couple residential brokers on Facebook who told me that interest rates were going to drop at the end of 23.
Yeah.
And then that number that date has just moved every 3 months for the last like year and a half.
Higher for longer.
And then I was like, guys, it doesn't, you know how it felt really, really good for like 2 years?
Yeah.
And then it felt like okay for like a year and a half, but we didn't do that many deals, but Resi still did fine. And commercial was just really slow, but everybody was still happy because rents were up and everybody could pay their mortgages.
I don't know if commercial brokers and appraisers were happy.
Yeah, but that's not. I mean, but that was a correction. I mean, there were too many commercial brokers and appraisers.
Oh, I see.
You know what I mean? Like,
There's never too many appraisers, but there's always too many brokers.
So you think this is a cleansing?
It's a cleansing. It's a juice cleanse. Yeah,
I
Trevor
see.
and I are doing one.
So you're saying you want less competition? So
I want the natural level.
Need a couple of years of no deals.
Yeah,
so I don't look at interest rates. What are you talking about?
Yeah. Well, that's why.
Why don't you look at interest rates?
Because I just call the lender and say, what is the interest rate right now? And then I figure out how to make the deal work based on that number.
That makes me feel so good.
That's a smart idea.
Because on our deal,
what happens when it changes the next day?
Then I make the deal work on that rate.
Date. Yeah. No, this is great.
So he doesn't actually underwrite 100 different deals. He underwrites the same deal 100 times.
Yeah.
Mark told me to have Trevor decide whether or not we should do fixed or variable based on what Trevor thought interest rates were going to do in the next year and a half. And I was like, I don't think I need to ask Trevor. I don't think Trevor actually pays attention to anything.
No, I do. So I think you always fix it if the deal works at that case, because it's easier to go the other way and change it later and pay a little bit of a prepayment penalty than it is to have your deal blow up by rates going higher. You're cutting the downside.
And that's the decision we made.
How many syndicators that did not fix their debt
3-year balloons, and they could have had
right now?
You want an exact number? Or
probably like 82.7%.
That is the wildest thing, because they could have they could have fixed, like, rather than 3.5% debt, they could have had 3.75.
Yeah,
5 or 10 years, and they took 3-year debt.
3-year debt.
But their model showed that they were going to pay back their investors in 3 to 5 years.
Mm-hmm.
So when you're looking at through that lens, that this is our business plan, their business plan was never to hold for 10. So they take the 3 to 5 year money, not thinking they may not be able to exit that deal because the whole world changes.
Yeah, they forgot to consider prices go down sometimes.
So you can have these are like $1 billion funds that forgot how to to see what was coming, right? I mean, this catches everybody off guard.
Mm-hmm. I would like to see the ratio of syndications that started in 2019 or later and syndications that were 2018 and prior, and which ones of them picked 3-year debt versus long-term debt. Because all the guys that I talked to who have been doing it for 30 years,
with long-term debt.
Yeah, they were like, yeah, I've got 10-year debt on 10 projects locked in at 3.8%.
Yep.
And we're doing great, actually. Yeah, our investors are super happy. We just had to tell them we were going to hold it for longer. It's like they don't care. It's
amazing when that cash flow lets you just hold.
Yeah.
I've got an interesting story about low interest rates and long-term debt
that you have right now.
So we just bought that other management company out of Portland.
Yeah.
And we inherited a lot of properties. One of the owners owns a lot of property. Very wealthy guy, has a big loan with I think it's PPB, Pacific Premier.
Yeah.
And his debt is like 2-point-something% locked in for 10 years. And because we switched management companies, we bought him. He didn't switch. He's still on the old contract. They sent him a default letter, said your note's due and payable now. Because you switched management companies without asking for approval. So this is turning into a big legal battle over he's still on the old contract. He didn't switch management companies. We just merged or bought out the company. He has the same manager, the same people, and everything. And so all we did was a name change, basically. And anyway, so big fight over there. I mean, they need off of these loans. They need to get out of that 2% money.
This is the first time in 30 years it's been advantageous for banks to call notes. They're incentivized for the first time ever to call notes.
30 years or ever?
30 years, 80s.
What happened in 08? They didn't want to call notes? They just let them sit.
Well, rates have always been, the past 30 years, rates have just trended down. So the past loans have always had.
Yeah.
Well, and when you call those notes, I mean, so the advantage to the lender is that they can go out and deploy that capital and make more money on it, obviously. Mm-hmm. But, you want to be in a market where you can do that. So if asset values are down and rates are higher, they want to rebalance themselves and go out of some of those assets they think might have been overpriced when they lent on them. And then they go into these, lower valued properties at much higher rates.
Mm-hmm. I doubt they try to foreclose on them.
Mm-hmm. Well,
bullying, a form of bullying.
They might, but I think there's already been a couple of things that happened in the first few days that I believe that this will all get settled and it won't be. But the immediate letter was like, we've reviewed it. You've broken your loan covenants and you're in default. Like they're claiming he's in default. I mean, it just blew me away when I read the letter. It's total bullshit. But
how do you feel about, so commercial notes have a requirement to show financials upon request on a yearly basis. I got that from a seller just today where he wants that in his note, which is he wants the ability to ask for my financials.
On your seller carry note?
I'm on seller carry
Interesting.
note.
Yeah. That's smart, really.
Yeah. That's what I said. I'm like, I have no problem.
But does he have any provisions in his loan that he can call it due if your financials don't line up with what he wants? So
and we're at this is the addendum of the purchase agreement phase. So we haven't even gotten to the note verbiage phase. So maybe when we get to that point, he wants to ironclad it into a default clause as well. And then maybe we go back and forth at that point. But my personal take is, I mean, I want to show that I'm a valid credit, borrower. And I want him to be a happy creditor, so I don't have any.
Yeah, it's almost a full-time job for me sending stuff to banks that they're asking for all the time. And in years past, I actually had a client who he said every year when they asked, he sent them the same tax returns and operating statement for the same year. Every year they asked for it. He said like 8 or 10 years in a row, he just kept sending the same one. He said they never even noticed it was the same one. The point being, and I haven't done that, but the point was they're not really looking. It's just somebody's got to go through and check a box because they've, that loan is sold on Wall Street or whatever happens. And so they got to make sure they're stacking all of the information in the file. But now today they ask for that information and you'll get an email back and go like, well, what's happening over here at this property? And how come you have this, tell us what's happening with this vacant unit at this property. It's like, what do you care? Like, we've owned it for years,
So now go back to the residential crash and then the short sale. Banks had to create short sale negotiation departments and REO departments, and this whole plumbing had to get created. And so now, and it was a financial mandate for them to figure this out, to dispose of whatever they had. Now it's almost a financial, economical, just litmus test for banks to go in and now start reviewing their borrowers to get out ahead of where their balance sheets is potentially going to go.
So they're trying to gauge exposure.
Yeah.
Trying to see where, so they're worried there's a fallout coming is what they're telling you. Is they're worried that they want to be reading everybody's balance sheets because they want to see where you're at right now.
Yeah, it's no different than us putting together a balloon schedule on all of our balloon payments and just getting prepared of what assets do we need to move when so we can get ready to this balloon payment coming up. For them, it's just default alert, because then that's when they start getting bad. What's that?
Do you put a schedule of all your balloon payments?
I hope you do. Yes.
You don't just wait for the seller to request their dollars.
Well, I mean,
paid in full in 30
actual.
You should get a Trevor. No, Trevor tracks all that stuff.
No, I like to
get one of those.
I like to get ahead of it, and I like to communicate beforehand.
He's my favorite.
I asked Paul that question. I said, "You keep track of when all these notes are coming due?" He goes, "Nah, I don't pay attention to all that." I said, how do you know?
He has a list.
I said, how do you know when you have a loan coming due? He says, "Oh, don't worry, they'll tell you."
Yeah.
Nah, he's messing with you. He has a list. I've seen his list.
He has it. I don't know how closely he studies it.
Yeah. So anyways,
can we use a seller note to create a future financial asset for our kids?
Well, I think the answer is yes.
By
but
overpaying
I don't know what
by significantly overpaying for a property with someone who's dying, and then freeze that. So you freeze a ridiculous amount of debt into the seller note, and then have a remainder beneficiary that's like your child.
Yeah, the note is an asset, and it passes down to the heirs. And
you mean you as a seller?
No, so me as the buyer is buying from a seller who just loves me, for example, right? And they know they don't have any heirs. They know they're going to die. They're like, I can't spend $1 million. Give me $50,000. I'm good. But then now there's this $950,000 note, and then if they have no heirs, there's no estate. They don't care. So in a note, you can create a remainder beneficiary. So then create the remainder beneficiary as like one of your kids, and now you have an annuity or whatever you want to look at is this note
going to one of your kids.
Yeah.
From this.
So now I'm paying off a note. I have a legitimate business expense. I have a basis. All this stuff that's good for tax reasons. But then that income actually goes to my child.
I think what you just said. Hold on. What you just said is you're just asking the seller for $950,000
from my future self.
Like, yeah, I don't know why they would do that, but sure you could.
Well, why wouldn't they?
Because he loves Mike.
Yeah, I mean, so you're just like, why would they not just give me $950,000? I don't see why not.
I don't know if there's a benefit for me at all. It's just kind of cool to think about that.
Well, do you guys ever ask questions?
Trevor's
confused. The answer to?
Is there a benefit for me in that? To overpay?
You're passing on your... Okay, so if you're overpaying, I don't see why this would happen in any scenario.
I'm just being stupid. That's what we do.
You're overpaying for the property by $1 million? Cool. Is that the
yeah, well, maybe not, but not that much. But yeah, so overpay.
To have a note.
That then eventually funds college.
You're saying you're paying the note.
I'm paying the note as the buyer.
To your kid who now owns the...
To the beneficiary who is the seller. And then when they pass...
They give it to
the remainder beneficiary steps in.
Well, if they love you so much, why don't you just ask to be their heir? Just pass it all to me. It's like all you're asking them to do is pass it on to your kid, right?
Maybe they don't love me that
much. They love your kids.
Trevor,
we were so sidetracked. 13 minutes in.
Is it weird being on the other side of it, Trevor? Somebody asking a wild question about a way that you could do a deal.
How's it feel?
And then you being like,
I've never seen a smile on it.
That was weird.
I love the idea, but I just don't know why.
This is what I tell you.
Well, here's the thing.
Well, you're welcome. I'm giving you good ideas. I love the thought process.
A great idea. It's just never going to happen.
A visionary's job is to create 20 ideas so 19 of them can get killed.
Yeah.
I kill a lot of ideas.
It's the whole smashing dreams. If you're not killing dreams, you are not doing the world a service.
Dane's the deal killer.
I'm the idea killer. And then it's like the one idea that's left over is the thing we're already doing. Like, it's awesome.
But one of these days, there will be an idea that comes out, and it'll be better than what we're currently doing.
You're right. No, and there have been. It's added to our tool belt. I'll give you that. It's a good thing. It's a net positive.
Somewhere along the way, this always turns into Dane and Trevor fighting over something.
It does.
No, this was related? This was happy. This was a happy accident.
Being that the spawn of this podcast began because they just wanted more coaching time It makes sense.
So what were we talking about?
Yeah, so let's get back on track. We're going to reel this shit back in right now. All right, so here's the big news. Here's the big news. Have you seen a headline yet? America's borrowing costs have started to go down. Started yesterday.
No. I don't look at the news very much.
But they will.
What are you saying?
The America's borrowing costs have now started.
Mike
going
always
down.
asks a question you can't answer.
No, he always asks questions he knows the answer to.
But we don't.
Yeah,
Dad.
Have you seen that headline?
No,
I have not.
No.
Like if our reporters cared about America, they'd be saying America's borrowing costs are going down because the Fed pivoted again. Here's the thing. How big of a turn is a pivot? Is it a 180? How many pivots does it take to get to a 180?
Depends on
1 degree.
Well, it depends.
There you go. So 180 pivots to get to. Now, I like that thought process because the Fed doesn't just turn around, and the definition of a pivot is you just go 180. No, they made a huge pivot this week. Huge
They
pivot.
went like
It was a
10 or
15
20
degree.
degrees.
Yeah.
Yeah, so they're essentially taking pressure off the bond auctions. They're taking supply pressure off the bond auctions, which is going to allow our government to issue notes at a lower rate. So our America's borrowing costs going forward are now cheaper based on this decision.
So let's break this down in layman's terms for me, because this is when we were talking about like the Fed letting these mortgage-backed securities run off their balance sheet.
Yep.
They were letting them run off at a pace of about $60 billion per month. They decided to drop that to $25 billion. So they're still in quantitative tightening mode, but they have backed off of the brake pedal a little bit, actually quite a bit, because they could have backed down 10 billion or 20 billion or 30 billion. They backed down 35 billion per month, which is fairly significant.
So I'm not going to sidetrack I'm going to agree with, yes, they're quantitative tightening, and to throw some numbers behind it. So if they have 100 billion of notes expire and mature, now they get 100 billion of balloon payments in. They used to they'd have to reinvest 40.
Yeah.
So that way only 60 would run off.
Yep.
And now they lowered that to 25.
25.
So now they have to invest 75 of that 100 of maturity.
So they've got 75 being redeployed into the market.
So demand is increasing.
So you're actually you're getting a little bit of gas pedal along with coming off the brake pedal.
I think it washes out to just a reduction on supply, but it helps that ratio, and that's what matters. And what I mentioned live the other night was what really freaking odd is when the rockets start going off in Israel, that is usually fleet of money, yields go down. Demand for treasuries go up, yields go down. But what was happening at this exact time was record levels of bond of America bringing auctions. So America needs debt because of all the spending package we have now, and so the Treasury has been bringing record amounts of supply to the bond auction
to borrow more money.
And so what happened is yields went up a little bit, so values went down a little bit. What kind of tells me is, well, demand did increase with that level, that what you'd typically see of free to safety, but we had so much supply coming in, record supply coming in from the Treasury, that we actually saw yields go up. And now if you think about it, so if the Treasury didn't come in, yields would have gone down for a fleet of safety. If
when yields go down, you're talking about like the 10-year.
The 10-year yield. That's what I'm specifically talking about. So it went from like 4.5, which we talked about in March, to when the rocket started going off, it got up to 4.6, 4.7, and not to 4.8, but 4.75-ish. So if you think of the forces in play, so if the supply doesn't come in from the IRS, we did have an increase in demand, yields would have gone down. Reverse that. So if the supply comes in, but we don't have the fleet of safety because of rockets, then yields would have gone up even further because of the record amount of supply coming in. And so now bring that back to the Fed changing. That's a similar component that's happening now, which is the ratio of supply demand is now going to lower, which means values are going to be higher, which means yields will be lower, which means borrowing rates.
So the price of a bond goes up.
Yep.
And the yield goes down. And to your point, by the way, side note, if you live in the Salem area, first Wednesday of every month, we meet at the Sassy Onion Salem Real Estate Investor Group.
1230 State Street.
There you go. It's a great meetup, good energy, bright minds. Mike gives a market update. We have a guest speaker. We provide free food. It's free to get in. Plenty of parking across the street from the venue. So come be there in person. It's a lot of fun. Going back to what you talked about the other night, I'd love for you to break that down a little slower than what you did at the meetup. So when we go into this missiles are in the air thought process, normally, to your point, there's a flight to safety, which is simply saying, like, I may have money in stocks or cash or other things that I feel less comfortable with, and so I'm going to move that into the bond market, which is considered sort of the safe haven for your money, correct?
Yeah.
And when you move in, now more people are buying that. Does that then drive the price of those bonds up because there's more demand, which brings the yield down?
As long as we don't have more supply coming in while that demand comes.
So technically, theoretically, if we imagine this, if we have all of this geopolitical turmoil in the world today that we have, and people are worried about World War III and who the next president's going to be, shouldn't there be more of a flight to safety, driving that yield lower and in turn making our borrowing costs less?
Yeah, and that's what's the weird phenomenon that we have going on, which I kind of started to allude to in the April meeting, which is a scenario where, when did I actually say this? But you think of allocation. So let's step back and go globally to allocation. So that's what investors do, especially macro money. They talk about diversification. So it's just an allocation. Where do you want to be? Right now, there's a lot of different places to allocate for safety. You've got a lot of money in money markets. And so record amounts of money in money markets. So it's sitting on the sidelines, waiting to pounce. So that's why, like, your 2-year treasury, why we have the really long inverted yield curve, is because that short-term money that would typically be invested in a 2-year to get a yield doesn't even want that. They're sidelines so it can pounce.
So tell us, just for our listeners, inverted yield curve. So that means that the 10-year is higher or lower than the 30-year or?
Yeah. So,
or is it the 2-year and 10-year they look at?
Yeah, the yield curve is extremely important from an investment analysis standpoint because macro money always looks at trade-offs. And so you go to the base and then you adjust from the base. So the safe investment is the 10-year treasury note. Now, or the treasury note in general is the safe investment is the government as your borrower. So as a lender, you want to lend money to the safest person, which is the government borrowing. And then everything else is more expensive than that. The borrowing gets more expensive. The lending gets a higher yield. So
to be inverted, what these numbers are looking at? So you look on a timeline.
Yep.
The 2-year is higher than what the 10-year is. So the outlook is it's worse now than it's going to be.
Yep. So the easy way for me to remember this is you want a lower rate of return, a lower interest rate for your shorter term stuff. And as a lender, you want a lower yield. So like a 15-year to a 30-year, right? A 30-year rate is always lower. So for the borrower, you get a better interest rate. For the lender, you're taking on a lower yield to get your money back sooner. So the 1 year, the 1 year, the 7 month, the 1 year, the 2 year, the 7 year, the 10 year. So your yield should be increasing as that time gets longer.
Should be higher.
Correct. And right now we have all those shorter terms are a higher yield than the 10 year. And what that's showing is a concern for a recession. So money comes to the sidelines instead of being in that short term.
Okay.
So you think of the yield curve, money allocates itself across the yield curve. So that means it wants to be invested on 1 year cycles, 2 year cycles, 10 year cycles, mortgage-backed securities, so another 7 to 10 year cycle with a better yield. So now they stack their investments or they allocate money based on where those yields are. And so that's why we talk about mortgage spreads and stuff like that. And so we've had the longest inverted yield curve that we have ever seen. And on top of that, it's been a very large inverted yield curve, meaning the spread, the amount of the 2 year being higher than the 10 year has been a large amount.
Bigger spread than ever.
Yes.
Longer than ever, bigger spread forever. Always an indicator of recession, correct?
It's been like 100% for the past however many.
So does that mean we're in the recession now or we're going into the recession?
I think that what it shows is that there's concern for a recession or there's concern for short-term pain. And this is, again, allocation. So why is money at money markets is opportunistic? I think macro money, there's a significant amount of money out there still, even though it's running off the balance sheet, sitting on the sidelines ready to be redeployed. And like, I was having this analogy the other day. If you think of like the office market right now, everyone is looking up. So you get guys like me that have never bought an office tower, like, I'm going to buy an office tower this year. And then you have the guys that have the 5-story towers are like, I'm getting the 20-story tower this year. And then you have the guys that have all the 20-story towers are like, we're buying 50 towers across the nation this year. But no one wants to act. We're all waiting. What is that discount rate? Where does it make sense? When do we start jumping into the market? And so the way what you typically see is these recessions boil and boil and boil. And then all of it, and you're in it. And then it flips overnight, and then the market kind of takes off. So we're in this weird period that the higher for longer, as long as this continues to drag out, it pushes in real estate, it extends our recession, which kind of, and it's more a volume recession than a price recession at this point. And then it's going to make that jump higher.
Well, in residential, it is. I think in commercial, I spoke at the appraiser conference yesterday in Portland, and it's very interesting the difference between residential and commercial, because I think that cap rates don't matter to a home buyer. And so
right.
You come out, somebody buying a home, somebody that's getting this 5% down, I can get into 1 to 4 unit. These people want to get into investing. They're willing to buy a deal that an investor is not willing to buy. Once you get into 5+, it's very much driven by debt. And as these rates have doubled, cap rates have changed, values have dropped. Jamie Dimon said the easiest way to understand this, he said if interest rates go up 3%, the value of your property goes down 30%. And so there is, it's not a 1-to-1 change interest rate to cap rate, but it does affect it greatly. And so, it's really weird. I was looking at a graph yesterday, and it was showing GDP, and it was like, I'm looking at the graph, and I'm like, all of the quarters that were the highest were like my worst personal quarters. And when they drop down below, the zero line, and we go backwards, like what do we have to have a recession? 2 consecutive?
2 consecutive.
So I think we had 2 consecutive in the beginning of 22, actually, on the graph that I looked at. And I'm thought, I mean, if you ask somebody in real estate, a broker, appraiser, especially commercial investor, like, we will probably look back at the first half of 22 as the best time in our investment career.
Absolutely.
But the economy as a whole would have been considered to be in a recession. And so maybe, when we talk about recessionary fears, this is kind of a Main Street thing. Like, people are worried, am I going to lose my job? Is my income going to go down? What are these things that happen when you go into a recession? For us, over the last couple of years anyway, in the real estate industry, we feel like it's just been like this super laser targeted pain on us, trying to come straight down on commercial asset values, straight down on commercial investors, commercial brokers, commercial appraisers. This entire industry just got rocked. And I mean, so it's hard to not feel like we're in a recession when we've had the worst couple of years that we've had in a long time. And then everybody wants to know, when are we going to come out of that? The weird part is like, then, like you're talking about the, they announced, well, job report came out today, right? So job report comes out today. The job print is much lower than what they're expecting.
Oh, good.
Unemployment is higher than what they were expected.
Great.
And so, okay, so Mike's saying great. And you guys are, I don't know if you have an opinion on this, but Logan DeVos and I were texting early this morning. He's like, oh, look, maybe we can get back on the government tit again.
Yeah.
Because like all the data's going wrong. And I'm like, this feels very strange to be applauding bad news.
It's the worst thing ever.
Like, what sort of an economy do we set up to where we need it to go bad, things to go good?
For us specifically, because of where we work in the asset classes we're in, the greater economy in a recession and getting the government tit is really good for us.
I also think we should clarify that we're super biased. I think that's what you're trying to say.
That's what I'm trying to say.
We're really biased. The economy's been doing pretty good for the last year and a half.
I mean, people are complaining that prices are high and they don't have as much money in their pocket, and they're saying 50% of renters are financially strapped, and there's all these headlines around how bad people are hurting. But when you look at the macro numbers, it would say the economy is actually doing better than it has for quite a while. It's just in our particular industry, which I think makes up a really big portion of our GDP. Like, when you really look at commercial real estate, commercial lending, all of the facets that our industry touches, especially on the commercial side, I mean, it affects every nook and cranny. So if you don't happen to be in commercial real estate, it may not hurt as bad. So then
Commercial real estate's even worse than residential real estate.
that's what I'm saying.
Yeah.
It's a lot worse.
Yeah.
Residential had sort of a hard winter, but then came out.
No, it's fucking hard, dude. 18 months. It's bullshit. Nothing like yours, though.
Guy. Yeah.
Here's what I would say. Going back to the economics, here's the best part about this market. It is proving that the best negotiation tactic out there is the takeaway. Does anyone disagree with that statement?
What do you mean by that?
So
The best negotiation tactic is the takeaway.
basically what you're saying is it's no longer a seller's market, it's a buyer's market.
No, I'm saying that whenever you're in a negotiation, whether you're the seller or whether you're the buyer, at a certain point, walking away from the table is the best negotiation point. So as a seller, it's the send termination comment. I'm done, send termination. And then that always brings the deal back together. As the buyer, it's like, go put it on the market or whatever it is. And then that brings the deal back together. Here's what I'm seeing. Almost every property we are selling sits on the market at least a week, 2 weeks, 3 weeks. One person makes an offer, multiple offers.
Yeah, waiting.
Yeah. So people think they can wait and they want to look around, but they don't have inventory to look at. And so once that gets taken away, someone's buying what I want.
I agree with that.
Yeah.
Yeah, I've seen that.
That's human psychology.
Because right now I have a bunch of stuff that we are listing and selling, and I've seen that like sat. As soon as we had 4 offers on the.
It's how it really always works.
Yep. I got it. So for example, I like to read my email in the morning, and so my we got an offer in, and my managers like ran a net profit scenario, and I'm thinking, gosh, we had another invoice coming in, and so I look at it in the morning, I'm like, I'm not happy. By that afternoon, I accepted an offer, 27 grand more in profit. Just because one person went, it was a lowball offer. They thought they could get away with it. And we always see this. The person that goes first wants to get back in the game, and then they lose because they're not respected.
So they're just going to keep chasing deals.
That's why Trevor's been sending himself offers from other. He noticed that trend, so he started.
And I had
3 or 4 offers for his own properties.
So here's a really good.
We're in a multiple offer situation here.
Call every broker.
3 of my entities have written on this same property.
It's
Make
a
your offer now.
deal. They all underwrote it differently too.
Bring highest and best by Friday at 3 p.m.
So what do? Go talk to your 3 different partners. Hey, we're competing with partner number 1. Well, partner number 2 wants to do this, and you're in the middle, just like my commission's getting higher. I mean, what's
Gabe does always end up in a bidding war with himself.
I'm so dumb that Mike sends me an email and he goes, "Let's talk about this deal," and I'm like, he goes, "You already wrote on it twice or something."
Oh, this is the best part. I'm like, I finally send him an email. He's like, "Oh, that deal." And I'm like, dude, we've been texting about this for like
so
8
long.
days.
You got to send it to me.
I didn't realize we were talking about the same deal. I've already that one, the one that I've already written on in 2 different partnerships. I guess
There's a lot of those. I need pictures. I'm more of a picture guy.
Yeah.
Yeah.
Well, it helps if I don't try and voice text and then Siri just the message is
True.
what goes through your guys' brain when you see my
So,
Siri message?
Dude,
I just feel bad because we just talk a lot of shit after you text us, but I thought you were trying to text us about something serious, and then we just make.
we're going to rename him Mushroom Mike instead of Macro Mike.
half your text seems senile.
He starts speaking in tongues.
So
then, then he blames it on Siri every time.
I do.
What is Mike talking about?
I have to.
He's like, "Oh, damn it, Siri again."
I throw it in
let's
Google
dive into that
Translate
because you
every
want to.
time.
Yeah, you want to talk about what that last text was, and you're going through some transition and doing all this stuff, right?
Yeah, well, and this kind of actually a good segue what we were just talking about of, do you put your best foot forward? When do you lowball, when you do all those things? And so let me contrast that and then kind of segue into that. So right now I'm working on an office tower, and brought to me by one of my brokers. We've been talking about buying an office tower for a long time, or towers in Portland. And it's funny to watch him negotiate, and he's negotiating 5 days in between emails and huge price reductions, and we know what will get accepted. We've been told what will get accepted, and he knows what will get accepted. And I'm sitting here going, let's just write the fucking offer at what they want. And then watching him, because in that asset class with those market conditions, that makes sense. It's coy, it's smart, doesn't reveal our position. And so it's odd for me to kind of sit back and see someone negotiate that hard. His style works for him. I'm just not kind of that guy. I'm more of a relational side. Now contrast that with the deal I'm doing right now in Salem on a duplex where the property I'm trying to buy is located in an area of town where I want to be invested. It's got a unique piece to it. The owner owns another property and then another property I want. So it's a really important piece. In a scenario where a realtor is involved, here's another thing. I talk shit about realtors a lot. There's some really amazing agents out here, and this was a really cool experience where there's an appointment to meet the seller. Realtor shows up. I was already talking to the realtor or to the seller. Realtor kind of comes in, and then as a buyer, you're like, okay, now they're coming in to try and mess up our deal and trying to build rapport. And there's that awkward moments as you're trying to build rapport with the seller, and then the broker's trying to keep the price up, and then they hand you comps, and then they tell you this, And so when I submitted that offer, instead of just submitting an offer, I gave a really long scenario of here's how I would run my numbers. And, you told me you wanted this price. And if I would normally run my numbers, I'm 100 to 110 less than that price. Here's what I'm going to do. I'm going to try and meet you in the middle. And here's why. So now in a scenario, I'm trying to put my best foot forward. So completely opposite of that other scenario, which is market conditions justify being coy, waiting to pounce, let other people go first. Whereas this one, it's residential. There is more demand. She can put it on the market and get what she wants. So there's this whole now, okay, put my best foot forward and now then appeal to other things about price. And this agent, I'm a fan, huge fan. She asked the best questions. God,
shout her out. Who is it?
Holly Eccles.
Oh yeah,
you heard of Holly?
Yeah. Heard great things about.
She's
Holly.
amazing.
Yeah.
And it's I love to hear this thought process of I can't even believe I'm talking about this. Go in her brain, her right brain, what's been told by the industry versus the questions she's asking and how she's wanting to structure stuff. So, it's kind of cool to just watch that process of how you act differently based on different market conditions and different types of properties, and then the goals that you have over yourself. If that kind of makes sense.
So let's go back to your office tower.
When does it turn from an office building to an office tower?
10 stories.
It's 10. Yeah. Okay.
How is it an office tower?
Yeah.
The one you want to buy?
Yeah.
It's 10 stories?
How many is it total?
Wait, hold on. Before you talk about, hold on. Let me give you a warning.
25.
Hold on.
Yeah, no, we're not going to get into those types of details.
If you haven't put under contract yet, think about what you're about to say.
I thought you put it under contract.
It's close.
Oh,
close.
That's what you said.
We can talk high level. We've learned to not talk specifics.
Okay,
until it's close.
So you're trying to put an office.
I will have it in escrow before this thing gets.
Okay, I want to go deep. I don't care about which building it is. I want to know what. So you want to be a contrarian. You want to go buy office towers because office is in the shits, vacancy's high.
Okay, so no, I don't like. I would say this.
Do you own office?
I'm a basis investor.
Okay, you want to rip something.
I want to.
You can rip office right now. I love the idea.
Yes.
So that's why I'm going down this road. So do you own other office? Do you know that?
I own my office space, and I have owned a couple other small commercial buildings. So I do not have experience in anything like this.
So you're not. You negotiate lease, triple net, modified gross, all this. Who are the brokers who fill it?
Yep.
What's the business plan? You don't have that in your brain.
I've done that once or twice.
Not on this scale. So
never on this scale.
So do you have a partner?
Now I'm already scared because I'm getting out of my lane. Clearly getting out of my lane. 100 per. You can't get further out of your lane. I probably shouldn't do this, but keep going.
No, I mean it's a good point. I mean it's exciting to jump into a deal when you feel like you're ripping and I'm guessing that the cost basis is pennies on the dollar for office right now. If you might find a deal.
What's the price per square foot? Ballpark. $50
per square foot.
Per square foot?
Yeah.
For a nice building.
And the way I look at this is you can't, that's your soft cost to get the entitlement to build it.
Yeah.
Without the land.
You're still dirt. You're still dirt at that point.
Yeah, you get the land for free and you have a little piece of paper that says you can build. It costs that much.
So this isn't out of your lane because this is your model.
Yes.
Get the
You're
land.
Yeah.
You're a land guy.
It's a land bank. It is a land. Look at it as a land bank.
I still don't understand that, but that's your model and that's what you do. So this is a land bank.
I met a guy from Australia in Las Vegas once and he said I land bank. Oh, we had the best conversation. Sorry.
Okay, so you think the land is worth X amount. You can't go rebuild this thing. You're getting it for a great deal. Can it float? The question is, can it pay for itself?
No.
And you go
no,
it's empty.
So
no, it's empty.
But once you fill it, will it pay for itself?
Well, so that's the that is the big question.
How do you feel it?
How do you fill it?
What's it cost to fill
What's it cost to fill it? Which we have a good idea of that, but what kind of income are you going to get?
I mean, somebody asked me the other day, like, have you ever written $100,000 check to a leasing agent to lease a space?
We've got $500,000 in our budget.
For leasing.
You got to pay the whole fee up front.
Yeah, I've done leasing before.
Well, that's what Bob talked about.
Okay, we found a leasing agent.
You have $500,000, we'll lease it.
Yeah.
So, well, Bob Thomas spoke on that in person the other night. He's like, San Francisco, an agent that just leased to Google, they have a $7 million check.
Mm-hmm.
Yeah, so you have that baked into your budget. Leasing commissions are baked in.
So we've got $1 million to absorb the building, which is TIs and leasing.
Why is it empty right now? Why does no one want to lease it?
A failed project.
So it's new. It's a new build, or it's a remodel?
It's an REO. So it's an REO that went through acquisition, renovation. And
REO,
then
it's bank owned.
by the bank.
So it's the renovation is done.
Renovation's done.
It's all completely done.
Yep.
Is it
Why-
vanilla interior? Like you have to do TIs to build out units, or there's units?
Yeah. So 33% of the TIs are built out. You've got 6 floors you need to build out in TIs.
So you have to go in and finance those TIs, or how do you have the capital?
That's part of that $1 million.
So you think that 66% of it can be TI'd, and you can pay all the leasing commissions for $1 million. That's your budget.
That seems really low for TI.
Well, we don't know how big the building is.
Correct.
You want to let him talk about
It's
it.
really big. Okay.
No, that sounds low because of the state that the building's in now, and then the thought process is you're not paying for all the TIs. You're dropping some, and then a lot of times you negotiate some of that into your lease. You pay for some, you negotiate. And I want to do more of and this is where I need to actually build out on whether I can build this as a business plan on how do you absorb that lease out. And so we may need to just jump a lot more into TIs. For that
I'm not an office broker or leasing agent, but it's my impression that in certain asset types, you can still get a tenant to cover their TIs or a portion of them or finance them into their lease. Whereas in office, you're having to bend over backwards to complete a lot of those TIs for a tenant. And even if you financed it for them, when you think about the kind of money that takes to do some of these TIs,
Mm-hmm.
I mean, there's just a small building in downtown Salem. I think it's only 2 stories, and they just did a TI on about a quarter of the building. It was like $700,000, and that was like low bidder. I think the other contractors were like $900,000 or $1 million. MCG did a space for the state downtown, and it was, I mean, just one space. It blew me away. I mean, it's like $600,000 or $700,000 cash, just bam, out of pocket, because the state says we're not paying for the TI, but we'll sign a 20-year lease with escalators and everything in there. So the value of your building goes up dramatically, and I'm sure there's a way to unlock that equity somehow at some point. But that's all just money. I mean, this is like what we do on a huge scale, much bigger dollars.
Yeah, but your point is you're already built out to the end users who will kind of have that there already. Like you're not going, were they doing kitchens and all that kind of thing?
It's not a speculative. So it's not a speculative thing that you're building out, right? Like
you
a lot
know
of
who's going to go there and be the end user.
Before you spend the money.
Yeah, before you spend the money, you already know who they are. Is there demand for that space?
So this is where it gets scary, and this is where you rely on people that are a lot fucking smarter than you are. And you start talking, because I've never been in that space. And again, Bob Thomas would then now rely on, hey, he's in town, go take him out for some drinks, took him to your building, actually had some pizza and whiskey sour. And then you start talking, office tenants of those size, they've got their pick of the litter right now in Class A. So what happens to Class B and Class C? What type of amenities do you have to offer? We don't know, and this is where the trepidation or the angst comes in the office world, is in these metro areas, what is the new mix? So what's really good about residential is we can get a good idea of migration patterns. So we have an idea of these are the amount of households we have. This is how many households we're going to need in the future. This is how many housing units we have. Here's how many housing units we're going to need. So take that same thought process to office. When work from home has happened, all of these renovations have been happening because we are just on the back end of this office boom. Mm-hmm. Every big project that started in 2019 is going back to the bank. It's going back on the market. It's going to have some type of reposition. You have a lot of vacant office space out there. You have a lot more vacant office space coming. So where is that all going to fall into the A class, B class, C class? And then how many actual tenants do you have in the A class, B class, C class? And so I think the thought process is, and as a basis investor, is you have to rip it at such a price that if you miss in the office world, you can reposition it into a different asset class.
Can you reposition that thing?
So that's the whole problem with old buildings is the way their plates are built is you really can't. And that's the risk that you're taking on these old buildings.
So you buy something really, really, really cheap. Like, I mean, what do you think it cost a foot to build a building like that?
Fuck, $300, $400 a foot?
I bet it's
More?
500.
Yeah.
I bet it's 6.
Mm-hmm.
I bet it's 7.
It's a lot less than 50.
No.
Okay, so you can't build that building for any. So let's just say, I mean, you're buying it for 10 cents on the dollar, but it's empty in a market. We're having, like, we had the retail apocalypse several years ago. Retail had to kind of reinvent itself, and you saw the malls. Now everybody shops outside instead of inside. I don't know how that really changes anything, but then we go to office and people go, I remember like a couple of years ago, I was going, oh, it's no problem. Everybody works from home now. So we'll just convert these office towers to multifamily. Nope.
Can't.
Because there are maybe 10 or 15% on the high side that can even be converted because like what you're talking about, the way the plates are, you know, set up, plumbing, electrical and all that, they're not laid out to be apartments. So what do you do with a building? You buy 10 cents on the dollar. You know you couldn't build that, but you may not be able to fill it for a number of years. Like if you just had a ton of money lying around, it might be a great thing to just go like
all cash and sit on it.
All cash, sit on it because you don't have any. Yeah, you don't have any bleed or debt service or anything. You're just like it's like talk about land bank with an office tower on top of it. We'll wait around till as long as the building doesn't fall apart and you maintain it as you go. Like in a few years, you hope to start filling that up, even if you do it at a discounted rate and then just kind of bring the thing back to life. It might be a 10 to 15 year play.
Yeah, and so you just need to then look at those different phases of value creation and where your opportunities to refinance and get your cash out, and that's how I look at it.
Will banks get involved in a deal like this?
Not until you get some income that they can actually feel confident.
So how do you finance it? How do you find the money to do a deal like that?
Just pure equity. So
you're raising all equity. You're raising investors to go buy it with cash and sit on it.
Yep, that's the goal.
What do you think? Like,
how much do you have raised? Do you need help?
He doesn't even have it under contract yet.
No,
you got to start raising before it's under contract.
And how do you
writing a check, man?
You can't pitch returns to an investor on that because you don't know what they're going to.
You can fill this up to some extent, right? Like what is your like best case, middle, worst case? Like let's say it's the worst case scenario. How much of this building do you fill? How much income does it bring in?
Yeah, so some of the numbers. So you have an interim plan of how do you start activating it and getting income in, and I've got an idea of that. How do you run numbers? So what I did is I just ran a ridiculously conservative number of $1 per square foot of the entire building, and then what's it worth in 3 years, what's it worth in 6 years, and I think we can get it to a point where within 3 to 6 years you get all your cash out plus $1 million or $2 million.
Okay, so $1 per square foot though, but how much of that is vacant? Like, can you fill this whole thing at $1 per square foot?
I don't know. That's where
you got to do some rent comp stuff. But I mean, Portland, typically that product, depending on what class that building is probably more like $250, $3 a foot.
Exactly.
So you're given a rip of a deal. You think you'll get people in there to some.
So and that's how I've underwritten is you don't have to. If we can get it to a reasonable occupancy level at $1 per square foot and no rent for 3 years. In 3 years, the buildings were 3 times what we paid for it.
Okay.
Yeah. And so it's like some rough numbers. I think it's going to take $8 million. We'll be into $8 million 3 years from now. And at those rates, a $40 million building 3 years ago, which is essentially what this thing appraised for as a development project, I think 3 years from now could be worth
Is this the building you showed at the meetup one day?
No.
Okay, you showed one kind of like
but
that.
it's similar.
Well,
it's very similar.
What's the address?
Does it have parking?
We don't need to talk about all these fine details.
No, continue on.
Yeah,
sorry.
But the way, so I think we can be all into the building at about $8 million 3 years from now, and I think it can be worth about $14 million 3 years from now. And then if we can, then at that point get $10 million of leverage. And that's interim one. And then the next cycle is now you get it up to relatively close to market rates. And now you have a $20 million building.
Yep.
Now you go get a $15 million loan. And then I think it's a reasonable expectation that once we're through this office cycle and all that space is reallocated and we know how much demand we have, we know how much supply we need, then it can be a $30 million building. I don't think it gets up to 40 million. I don't think you ever need it to. Yeah. It can, if you get it up to 50% of what it was worth as finished 3 years ago, then it's a freaking home run of a deal.
Yeah, so I guess the thought process there is just, can you fill it? Like, we know apartments,
yes.
So it's easy for us to answer that question, because it's like, I know if I went and rented these apartments out at 50% of the rate, I would have 100% occupancy. Mm-hmm. Like, can you answer?
No, I don't think anyone can on that scale.
Yeah.
But when you can compete with that low cost basis,
right,
at that price point, you're going to steal tenants from everybody around you, because nobody can rent for $1 a
exactly
foot.
And so all the other buildings that are traded, they won't even be on the market because they need these renovations. And so Bob Thomas, he and I were talking about, and he's pretty tepid about it. So where he just had a big boom, he's built a lot of net worth, he's got a lot of cash flow, he's got a 3-month-old, like, he has no desire to take on this level of risk. And so he's kind of playing devil's advocate. And after that conversation, that was my exact comment was, well, can't we go in and be early adopters, undercut the market, and now we're safe?
The risk is now this deal is the first of many that happened, and now you're competing with a whole new class of investor who came in and ripped all these buildings.
And then everyone under market rent.
So you have to be an early adopter on the absorption side to provide a level of like a floor of safety. Is how I view it.
The part I don't understand is how you raise money for folks that just want to let it sit there and not have any yield until
I can see that being not a problem.
Well, and here's the other part,
because if people are,
because he's going to raise all of it, like you're going to raise.
But it's not that much. It's $5 million, and if you can see your
he's going to raise $8 million
or $8 million, and then he thinks he can double their money in 3 years or whatever.
Well, I think it's pretty simple to be able to get I think you can get a $3 million loan on this if you escrow $5 million.
Oh, you could. You think so? You think somebody will give you a small loan on it? Okay.
My fear is just, can you bring in income? Because so there's some deals that you look at and you wouldn't even take them for free, because if you can't generate the income. So I just don't. Like, who do you call for that?
Well, and that's again. So
they're definitely, there's deals we've looked at where like we would literally need the seller to pay us to take this deal to pencil it out.
And right. So now that's your question. So is
no debt on it?
He's talking about putting $3 million of debt on it.
No, I know. I was saying.
This isn't about you, Dane. This is about Mike.
You would take it for free.
This isn't about you, Dane.
I can't think of a deal I wouldn't take for free.
Oh, there's deals.
Yes.
There's definitely land you wouldn't take for free.
Yeah.
I take that back.
Yeah.
There's
lots of deals you didn't take for free. Lots of deals.
You guys are small-minded.
So are you just trying to make the pie bigger, bring someone in who knows that space, you have the deal, you control the deal, you can do your value.
Yeah, what my avatar, so it can have a couple different rounds of funding, right? So you can come in and get a couple guys, take it down with a plan to syndicate it on a mini level. You can syndicate it again beyond that. I love the idea of partnering with business owners. And so here's where this is the transition conversation.
I like that.
Right? So the transition, becoming someone else. So what do? I don't know what the fuck I'm doing. Well, who do I know that owns a lot of commercial real estate?
Dude, this is your condo project that you love to do on your houses, but you do it on an office space.
So Gabe already gave me that idea. So
I beat you to it.
So and I wanted to partner with business owners to begin with. And for example, I had a conversation with a business owner who has a really cool business, works for one of the huge national suppliers, and he provides something to that. And here's the best part is they're a business owner and they have kids who love real estate, and so they just make a bunch of money and then give money to their kids to buy and flip real estate. So they're a basis investor. They understand flipping and forced appreciation and holding and business cycles. And so I want that avatar that understands we're at the front end. We're actually 2 shadow years into the front end of a 5, 7, 10-year cycle. And as long as we can weather that storm, the back end of that cycle is what the reality of the investment's the complexion is.
Yeah, so you share it with the business owners, you have them come in, their personal business income that they pay you for cheaper rent while owning part of it covers it for all you guys, and then you sell off the other floors.
Yep. So there's some house hacking, some office hacking component to it. So my partner on this has been office hacking. So this would be his 4th office building that he moved into.
10% down SBA loan to buy this.
There may be some component of that. Well, so
$5.5 million cap on SBA.
Well, that's where it gets really exciting. So I've got a business that can office office hack. He's got a business that can office hack. How many companies do we all know that could use office space, that love to own real estate, that love seller finance owners? Exactly. So, but we're already fucking talking about those prices.
That was your third one.
So now you create that. And when you're talking about structures that are this valuable, now you create an income stream. And then so what do you do when you're trying to become someone you haven't ever been before? Is you talk to someone who is that person. So I talked to Gabe, and he's talked about a deal in Salem where that's what they're doing, is syndicating, kind of condoizing the building and then just selling it back to the business owners.
What?
You're doing that?
I'm not doing it. No. This is Clutch is doing.
Oh, okay, yeah.
Yeah, right next door to.
Yeah, I've heard
PG,
about them.
Liberty
and I
Plaza.
saw the fences go up there last week, and I was like, "Well, that's cool.
It's a cool idea." Yeah, AJ Nash.
That was his idea that he talked about. I was like,
and Chris Blackburn. Those guys are sharp. They, that building has just ever since they built it, it's pretty much been empty. And I think it's
same type of thing.
It's close to 100,000 square feet. It was like 90% vacant. It had like skylights that were leaking and all sorts of problems that were going on with the actual structure. Owned out, before they bought it, it was owned by a group out of Canada, so they didn't really have eyes on it. They didn't understand our market or how to get it leased up, and so they came in and just ripped the thing, for pennies on the dollar. And then rather than trying to figure out how to reinvent it, they went out and syndicated it to the users of the building. So they went out around town and found the people that wanted to be in that building. They're doing a beautiful remodel on it now, and
they own pieces in it.
The tenants, the tenants will get to own a piece of their building that they're in. Everybody would love to own their own building, but most people wouldn't want to take on the risk of I'm officed in 10% of this building and I have to go lease out the other 90%. So to be able to just own 10% of the building and occupy 10% of the building, it's Mike's condo idea, but in downtown office.
And you set up a legacy for yourself later on as their idea on that when you sell out of your business and things. You've built equity, you've built value.
Yeah, you've built something. Now there has to be leadership. There has to be some sort of like an HOA. Yeah. There has to be, the sponsor has to, they're taking on substantial risk because.
Here's how you turn that into steroids too: is you don't fee simple condo, you lease hold the condo, and so you own the land, and then the condo has to lease the land from you.
I was going to ask if you were doing it with a ground lease.
Yeah.
Do you know if Clutch?
I don't. I don't have all the details. I know that they're still looking for investors and stuff on that project, but it's super cool, and it's a great model. I think it would be really fun to see how it works out for them, because it might be the answer to a lot of these buildings that are having problems.
It's scary. It's definitely scary to get into something like that. And honestly, I'd be happier to do it in Salem than Portland.
Take AJ Nash to lunch.
Yeah, I'm going to. You got to give me an intro. So I
talk about a brilliant mind. We should have him come on the podcast.
By the way, I got to chat with Logan DeVos for an hour yesterday.
Oh my God.
He was ready to go another hour. I was like, whoa, dude, I got to take a nap. I can't handle any more of this. Oh. But I'm excited.
Did you run this deal by him, or were you
not this one? No, I'm working on the 1031 tick strategy and then the 721 fund. So, are we just going into the becoming a future self now?
Yeah, or unless you want to cut to the next.
Yeah, maybe it's good time to cut. So we're
okay. Well, you want to cut? Talk about this. We'll cut, and then we'll talk about your future self coming back.
What are we talking about now again?
Well, this is a tear to my eye. We started Deal Junkies 3-4 months ago. And Mike was a residential real estate investor.
And now you're buying a $40 million office
double
building,
the square footage on his
portfolio. I'm glad Deal Junkies.
You know what? I remember when we started talking, I was like, hey, I got 6 months to get rid of this belly.
Yeah, I noticed that today at
10 pounds, baby.
For the record.
10 pounds, 3% body fat.
Hey, Sunday is only 2 days away.
I know.
We might need to put you on a cleanse.
I've got a 48-hour water fast.
Jan's putting Dane on a cleanse, so maybe you guys should do it together.
I texted Jan because Gabe was like, yeah, the cleanse makes me feel awesome after I'm done with it. So I texted Jan last night, and I was like, I want to do a juice cleanse. Like, I can, I've fasted for a couple days.
He asked her, do I need a blender?
Yeah. No, I didn't. I said, because I was downstairs at my new house, King of the Castle, and
fourplex.
I opened I know. It's great. It's actually, honestly, they cleaned it really well. That's all I asked.
Let's have a housewarming party for you there.
It's just you and Trevor. Yeah, you guys can come over.
Mike's not invited?
Well, I guess Trevor's not either because he doesn't own it. It's just me and Gabe.
The unrecorded documents say I own it.
Yeah, well, we'll see. Anyways, I opened my Ninja blender and I was like, I can totally do a juice cleanse now. And so I texted Jan. Turns out you don't need a blender for a juice cleanse. Jan thought that was funny.
You don't need to put the juices
weird.
in a blender.
Yeah, I don't know.
They're already.
I didn't know they were pre-juiced.
He's thinking he's got to create his juice.
I thought I was making fresh juices.
Yeah, I'm on a
Jan
juice
was
cleanse.
like,
I went and bought a juicer for my juice cleanse.
Yeah.
I'm not.
Do you have to do? Can I talk about the part that I didn't know about?
Oh, yeah,
juice
please.
cleanses.
Please do.
Dude, there's an enema involved.
Oh,
Yeah.
It doesn't surprise me.
It's more than just an enema.
Yeah, she was like, it's just a little bit of something, and she said it was like 48 ounces.
What?
Oh no, it's 48 ounces of coffee.
Yeah, Trevor. By the way,
Oh, a coffee enema?
I signed you up for
You
it.
drink it backwards.
That's yeah.
What?
I know. I drink a lot of coffee.
Oh, I've heard about the coffee enema stuff. I've
No. I just committed to do this. I don't know what I committed to.
No, I know. I got
Yeah.
to commit before I told him about the enema.
Juice cleanses.
So Jan's already ordered the stuff.
Is Kobe going to edit all of this out?
No. This is a commercial.
It's our
for
outro.
our sponsor.
Live well.
Live well.
Live Wellness. My wife Jen Johansson. She'll hook you up with a juice cleanse. You'll feel great.
She's a fantastic resource.
Oh, we'll have to hear how you guys feel after you do the cleanse.
Yeah.
I'm excited. She said that she thinks Trevor has more parasites than me, though.
Oh.
She said because I ate
Fired me
sushi
up.
every single day for like 6 months straight that
She can almost guarantee it.
Heavens. When did you
Well,
do that?
You're probably going to die from mercury poisoning.
That's
So now we
I'm
know.
never
So
gonna
now we
die.
know Trevor's future self. We'll come back in the next episode and we'll talk about Mike's future self.
I'm excited.
All right, guys, it's been a lot of fun. Stay tuned for the next episode. We're going to talk about Mike's transition. We're going to continue Macro Mike's transition. It's becoming an office
Into micro.
retail mogul. Thanks for joining us. We'll see you next time.